In this video, we're going to discuss how you can potentially contribute up to $84,500 to a Roth account in 2024. There are quite a few requirements, rules, and tips to avoid a messy tax situation, so make sure you stick around till the end of the video to get all the info that you need. Hey everyone, my name is Jake Skellhorn. I'm a certified financial planner. I own Spark Wealth Advisors, which is a wealth management firm located here in Florida. We help people across the country optimize their finances and prepare for an early or traditional retirement. If you're new here, consider subscribing to the channel to stay up to date on any future videos. If you learn anything in this video, do me a favor by liking it and leaving a comment below. So let's cover some basics really quick before we dive into the details of a Mega Backdoor Roth. First and foremost, the term Roth just means three things. Number one is that the contributions going into the account are after tax. In other words, you don't get a tax deduction for it this year. Number two is that the earnings, such as dividends, interest, and capital gains inside of the Roth account all grow tax-free. Number three is that all of those earnings can be withdrawn tax-free later as long as two criteria are met, and that is the account owner has to be at least age 59 and a half, and they have to have had the account funded for at least 5 years. So you can always access your Roth contributions, which is the money that you put into the account. You can withdraw that without paying any taxes or penalties. But again, just the earnings have to meet those two criteria. Now that we have this term Roth established, there are two different types of Roth accounts. There's employer-sponsored plans like Roth 401ks, Roth 403bs, and Roth 457 plans. And then there's Roth IRAs, which more people are familiar with. Those are individual accounts that are not associated with any employer. But the point here is that each of the two categories have slightly different rules and limitations that determine who can contribute to them and how much they're able to contribute each year. And that is where the term backdoor comes in, since backdoor is basically getting around those rules so that you can still add money to a Roth account when you otherwise normally wouldn't be able to. So let's start with Roth IRAs. Roth IRAs have what's called an income phase out. So in other words, rather than just setting one income level where if you make less than that, you can contribute to a Roth, and if you make over, you can't. There's a phase out where you slowly start to decrease what you're able to contribute to a Roth based on your income. So 2024's income phase out for single tax filers is $146,000 to $161,000. If you make less than $146,000 in modified adjusted gross income, you can contribute up to the annual maximum to a Roth IRA, which is $7,000 in 2024 if you're under age 50, $8,000 if you're over age 50. If you make more than the upper limit of the phase out, in other words, more than $161,000, you can't contribute any money to a Roth IRA. If you make somewhere in the middle, you can make a partial contribution. Just as a quick side note, if you do fall into that phase out range, whether you're single or married, the way that you can determine how much you can contribute to a Roth is by determining how far into the phase out range you are as a percentage of the total phase out range. So for example, let's say that you earn $149,000, that would be $3,000 into the $15,000 phase out range, which comes out to 20% into the phase out range. That means you can only contribute 80% of the annual maximum into a Roth IRA. So instead of $7,000, you'd be able to contribute up to $5,600. So we will call this phase out range the front door. So since this is what's stopping you from contributing to a Roth IRA, if you make too much money, you can do the backdoor Roth IRA. So the backdoor Roth IRA is just one extra step. It's making a non-deductible contribution to a traditional IRA, which anybody can do regardless of income. Once it's in that traditional IRA, you then convert it to your Roth IRA, which also has no restrictions as far as income. So it's just one extra step that allows you to bypass those income limitations. Again, there are a couple rules to follow and a tax form to file that I'll cover at the end of this video, but that is essentially a regular backdoor Roth IRA. The term Mega Backdoor Roth comes from the fact that you're using one of those employer Roth plans, which have much higher contribution limits every year. So you're able to put a ton more money into a Roth account than Roth IRA would allow. There are really two separate limits to keep in mind with these plans. You have your salary deferral limit, which for 2024 is $23,000. If you're over age 50, you can do an additional $7,500. So that's a total of $30,500. And then the other limit that you have to keep in mind is called the 415C limit, which is both your salary deferral limit, any employer contributions such as a company match or profit sharing, and then what's called a voluntary after-tax contribution. 415C limit for 2024 is $69,000 if you're under 50, $76,500 if you're over age 50. So if you take out your salary deferral limit, you essentially have another $46,000 between your company contributions and after-tax contributions that you can make into your 401k plan each year if your employer allows it. Again, I'll discuss that in more detail at the end of the video. So the Mega Backdoor Roth is essentially utilizing that additional $46,000 that you're able to contribute to your plan on an after-tax basis. Again, you would want to subtract any company contributions from that because you can't go over that $69,000. But obviously, this is a lot more than the $7,000 or $8,000 that you can do with a regular backdoor Roth IRA. So if we're keeping track, you can do $8,000 to a regular backdoor Roth IRA. You can do an additional $30,500 potentially if you're over age 50 just to your Roth 401k through the salary deferral limit. And then depending on how much your employer matches you, you could potentially put an additional $46,000 if there's no employer match at all into your after-tax 401k and then convert that to the Roth 401k or to a Roth IRA outside of the plan. So that would bring your total contributions to a Roth account for 2024 to $84,500. So let's get into a few tips, a few requirements and rules regarding both the regular backdoor Roth IRA and the Mega Backdoor Roth. First, I will say that I'm not a licensed tax advisor, so before you take any information in this video and act on it, be sure to consult a licensed professional that is familiar with your unique situation. Now, with that said, I'll start with the backdoor Roth IRA. There's really two main things to keep in mind if you're going to use this strategy. Number one is that you do have to file a tax form every single year that you do it. It's called Form 8606. And that is basically telling the IRS that the money that you contributed to your traditional IRA first is non-deductible, meaning you already paid taxes on that money, so that when you convert it to Roth, you're not paying taxes again. Because typically when you're doing a conversion from a traditional IRA to a Roth IRA, there will be a separate tax form generated, and it tells the IRS that there may be taxes owed. So again, Form 8606 ensures that the IRS knows you already paid taxes on that money and you're not paying taxes on it again. The second and probably most important rule with the regular backdoor Roth IRA is the pro-rata rule. So the pro-rata rule says that if you have any pre-tax amounts in any traditional IRAs, whether it be the one that you're using for your backdoor Roth or another one, those balances will be considered part of the conversion amount. So when you convert to Roth, part of that money will be considered taxable. So again, super important to be aware of any pre-tax balances you have in an IRA, whether again it be the same one or another one, because when you do that second step of converting the money, it could be considered taxable. Now, one common way around this is to take that pre-tax money, and if you have a 401k or an employer plan through a current job, you can roll that money from the IRA into your employer plan, and that way it's safe from the pro-rata rule because that only applies to IRAs. One tip I will mention for either the regular backdoor Roth or a Mega Backdoor Roth is that once you've contributed that money on an after-tax basis, either in your 401k or the traditional IRA, you generally want to convert it to the Roth almost immediately, because if you have any earnings or any interest that accumulates in that account, that is going to be taxable when you convert it. So to avoid that, try to convert it as soon as possible, because again, if you let it sit there and it grows because it's invested, that earnings portion is going to be taxable. The other piece to that is once it's in the Roth, you're not done. You want to make sure that money is invested, because the whole point of a Roth account is for the tax-free growth potential. So I see a lot of people do a great job of getting the money into the Roth IRA, and sometimes they forget to actually go in and invest it. Usually not a problem for the Mega Backdoor Roth, since 401ks usually have a default investment choice that your money gets swept into. But for Roth IRAs especially, you definitely want to make sure that you are going in there and purchasing investments and not just letting that money sit in cash. So with the Mega Backdoor Roth, a couple rules, requirements, and tips. Number one would be that your employer ultimately determines whether or not you are eligible for a Mega Backdoor Roth. So not all employers offer that after-tax contribution ability. Most now will allow you to do that Roth 401k for the ordinary salary deferral limit. But not all of them allow you to contribute additional money on top of that into that after-tax bucket that you need in order to do the Mega Backdoor Roth. So that's number one. Easiest way to find that out would be to call your 401k plan administrator, or you can check what's called your summary plan description, which is a document that should be available on your 401k portal. And just go to the section that says contributions. It should list out pre-tax, Roth, and after-tax if you have that option. A second tip for the Mega Backdoor Roth would be going back to how you need to convert that money right away. I have seen 401k custodians that allow you to check a box on their website where it automatically converts money in that after-tax bucket to Roth, since there's really no benefit to keep it in the after-tax. So make sure that if you have that option, you're checking that box. That way they will automatically convert it for you. It's a great feature that I've seen on 401k plans before, but again, not offered for all of them. Another thing to know about the Mega Backdoor Roth is that after you have contributed that money to the after-tax 401k, you either have the option to convert it to the Roth 401k, so still in your employer's plan, or you may have the option to do a rollover out of the plan to your Roth IRA. So Roth IRAs generally offer more investment choices. If that's something that you're looking for, check if that's an option for you. But again, it doesn't matter whether it goes to your Roth 401k or Roth IRA. All that money is going to grow tax-free. So the good thing about the Mega Backdoor Roth is that since the money going in on an after-tax basis is not going to an IRA, it's not subject to that pro-rata rule that we talked about a minute ago. So again, no pro-rata rule with the Mega Backdoor Roth. You also don't have to file that tax form each year, and it doesn't matter where the money goes after it's in that after-tax account. It can go to the Roth 401k or outside to your Roth IRA. It'll all grow tax-free regardless. Last thing I will say about the Mega Backdoor Roth is that if you're making enough money to be able to contribute almost $84,000 per year for retirement, then the chances are you're going to be in a pretty high tax bracket. So in that case, it may make sense to contribute to the pre-tax 401k for again, that $23,000 salary deferral limit piece, just to get that big tax deduction this year. And then the rest of the money you would want to fill up using the Mega Backdoor Roth. So again, not advice per se, but just something to keep in the back of your mind. So just to recap, if you are over age 50, you can do a backdoor Roth IRA for $8,000 this year. You can contribute up to $30,500 to your Roth 401k, and then you could potentially contribute an additional $46,000 as a Mega Backdoor Roth for a total of $84,500 in 2024. Keep in mind these limits are adjusted for inflation. They usually, for IRAs, go up in $500 increments. 401ks and 403bs sometimes go up in $500 or $1,000 increments. So these limits are likely to continue increasing. IRS usually releases those limits towards the end of the year, so keep an eye out for that if you are someone in the position to max these accounts out. If you learned something in this video, be sure to subscribe to the channel, leave a comment below with any questions, and thanks for watching. We'll see you in the next one.